Let's jump right into this explainer. Today, we're unlocking true costs. We're going to unpack the absolute critical differences between traditional cost allocation and activity-based costing, or ABC. Look, whether you're managing a massive manufacturing floor or you're just sitting there trying to figure out why your profit margins look totally off, the way you allocate overhead can literally make or break your business. Here is our roadmap for today. We'll start by comparing traditional and ABC costing. Then we'll run the numbers on a batch of toy flutes, scale up to costing custom windows, discuss exactly why managers prefer ABC, and finally we'll pull it all together with the Wilkerson case strategy.
So let's kick things off with Section 1, looking at traditional versus activity-based costing.
Now, traditional costing usually relies on lumping everything together under one single massive base, something like direct labor hours. But, as manufacturing becomes more and more automated, using just direct labor to allocate all your overhead, well, it's kind of like trying to slice a finely prepared meal with a sledgehammer. It's just too blunt. Activity-based costing brings some much-needed precision to the table because it actually assigns costs based on what specifically drives them. Let's look at this math in motion using product A for mini exercise 13.8. Say a product uses 10 machine hours at $35 an hour, 20 direct labor hours at $20, and 5 inspection hours at $10. ABC lets us calculate each of those pools completely separately. Add them up, and we land precisely at an $800 manufacturing overhead. Yes, it's slightly more math up front, but the accuracy you gain over just using some generic blended rate, it's massive. All right, moving right along to Section 2, let's look at calculating unit costs for some toy flutes. Imagine a factory floor churning out exactly 1,420 plastic toy flutes. Staley Toy Corporation needs to figure out exactly how much this specific production run costs. Now, pulling from exercise 13.20, we can see they aren't quite at full ABC yet, but they've at least realized that one generic rate is a total recipe for disaster. So they've split their overhead into 2 distinct buckets. Step by step, here's how it plays out. We isolate the direct materials at $960 and direct labor at $612. Then we calculate the overhead by combining their specific machine hour rate, which comes out to 60 hours at $7.20, and their labor cost percentage. And get this, they've set that percentage at an absolutely eye-popping 250% of direct labor cost. When we add all those elements together, we get our total manufacturing cost. Now, when we take that total manufacturing cost and divide it by the 1,420 units they produced, we hit our aha number, a final per unit cost of exactly $248 for a single toy flute. But here's the thing, producing the flute is only half the battle, right? Tracking it is the other half. Out of those 1,420 flutes, only 310 were actually sold in October. So managers have to take that exact $248 unit cost and multiply it by the 1,110 remaining units just to accurately value their ending inventory on the balance sheet. Think about it. If that initial unit cost is wrong, your entire financial reporting is completely compromised.
Let's scale things up a bit in Section 3 and look at costing custom windows.
Based on problem 13.24, Woodland Industry requires a much deeper activity-based costing approach for their custom windows. They produced 3,400 windows in July, and they rely on 3 distinct cost drivers instead of just one. Custom window manufacturing has a lot of moving parts, literally, so a single overhead rate just is not going to cut it here. Notice how cleanly this captures the true flow of their factory resources. By separating material handling, cutting, and assembly, Woodland uncovers a pretty major disparity. Just moving materials around, that only costs 18 cents per part. But the second those parts hit the cutting lathe, the cost skyrockets to $1.50 per part. So after adding the baseline direct materials and direct labor to those highly specific overhead pools we just calculated, and then dividing that whole shebang by the 3,400 windows they produced, we land exactly at $242 per custom window. Just look at these stark contrast here. If Woodland had stuck to a traditional direct labor base, the per unit cost would have appeared significantly more expensive. Imagine trying to price your custom windows competitively out there in the open market when your own internal accounting system is artificially inflating your cost data. There is no way you win those bids. Okay, on to Section 4. Why do managers actually prefer ABC? Well, managers prefer it for a very simple, practical reason: targeted troubleshooting.
If assembly costs suddenly spike, management can walk right down to the assembly line and figure out what's going on. Is there a paperwork bottleneck, a quality control issue? A traditional system just hides all those problems inside a giant, generic overhead bucket. ABC, on the other hand, shines a spotlight directly on what is actually driving your costs.
Finally, let's wrap up with Section 5, the Wilkerson case strategy. So, Wilkerson manufactures 3 products: standard valves, standard pumps, and highly customized flow controllers. Under their old traditional costing system, which was based completely on direct labor hours, that complex flow controller appears to boast this massive 41% gross margin. Sounds great, right? But because they're facing severe competitive pricing pressures across the board, management is starting to suspect that this 41% number is just a dangerous illusion. To fix this mess, Wilkerson has to map out a completely new flow. They need to move expenses into specific cost pools, define precise drivers like machine hours or engineering setups, and then distribute them accurately. This is absolutely vital because while the standard valves and pumps are highly automated, those custom flow controllers demand a massive amount of specialized engineering and setup time. Now, faced with all this complexity, some folks might suggest just clumping all the overhead into a contribution margin approach, basically treating it as a massive period expense and ignoring allocation entirely. But honestly, that would strip managers of the exact cost details they desperately need to remain competitive. You can't fix a profitability issue if you willingly blindfold yourself to what your specific product lines actually cost to build. The ultimate value of ABC comes down to this big revelation. Once it's fully implemented, Wilkerson discovers those custom flow controllers are consuming way more engineering resources than traditional accounting showed. They are drastically more expensive to make. Suddenly, that supposed star product with the 41% margin, it turns out it might actually be the black hole draining the company's resources. I'll leave you with this final thought for our explainer today. If your costing system is broken, your sales incentives are broken too. Think about it. Right now, Wilkerson's salespeople are being heavily commissioned to push those flow controllers because the old system says they make a huge 41% margin. But if activity-based costing proves they are barely breaking even on those controllers, well, they're literally paying their sales team to bankrupt the company. So how quickly would you change your commission structure once you finally knew the truth? Think about that, and I'll catch you in the next explainer.